Imagine a world where billion-dollar investment decisions are no longer left to human instinct, but instead guided by cold, hard data processed by machines. Where algorithms analyze thousands of private companies in seconds. Where due diligence that once took weeks is done in minutes. Welcome to the future of private equity. Welcome to the AI revolution. Private equity has long been the domain of high-powered analysts, strategic thinkers, and firms willing to take bold risks. It's a world built on relationships, intuition, and data, lots of it. But here's the twist. AI is now knocking at the door, not just to assist, but potentially to redefine the entire game. The question isn't if artificial intelligence will disrupt private equity. The real question is, how soon? Let's start by understanding the traditional private equity process and why it's ripe for disruption. Private equity firms raise capital from investors, by companies often privately held or underperforming ones, improve their operations and profitability, and eventually sell them for a profit. Sounds straightforward, but in reality, every step is complex. Sourcing deals is a time-consuming, relationship-driven effort. Due diligence requires months of combing through financials, legal documents, and operational metrics. Portfolio management involves constant monitoring, strategic decision-making, and endless forecasting. Every one of those stages can be transformed by AI. Take deal sourcing. Traditionally, it's about who you know, a network of bankers, lawyers, and insiders feeding you tips on companies that might be ready for acquisition. But what if AI could scan thousands of data points, financial filings, employee growth, online reviews, website traffic, patent filings, social media sentiment, and instantly surface companies that match your investment thesis? That's not science fiction. That's already happening. Firms are beginning to use AI-driven tools to create dynamic lists of acquisition targets. These tools don't rely on relationships, they rely on patterns. A company showing rapid hiring in niche tech roles, increased web engagement, and improved sentiment on review sites. AI can flag that long before a human analyst might notice. The edge here isn't just speed, it's depth. AI can see signals that are invisible to the human eye. Next comes due diligence, arguably the most critical and most labor-intensive part of any deal. Financials, customer data, legal contracts, HR policies, compliance records. Manually, this takes weeks, sometimes months. With AI, it can take hours. Natural language processing, a branch of AI, can analyze hundreds of contracts and flag unusual clauses or legal risks. Machine learning models can forecast future earnings based on granular historical data and market trends. AI systems can simulate multiple scenarios and stress test a company's performance under different macroeconomic conditions. Even portfolio management, once thought to be an art form, is being reshaped. AI can monitor portfolio company performance in real time, flagging operational inefficiencies, predicting cash flow issues, and identifying cross-sell opportunities across the portfolio. For example, if one portfolio company is excelling in digital marketing, AI might identify where those tactics could be applied to another underperforming asset. This creates synergy, not just oversight. It turns private equity firms into smarter operators, not just smarter investors. And then there's exit strategy. Predicting market conditions, beer appetite, and optimal timing for exit has always been more of an art than a science, but AI is changing that. Predictive models trained on vast datasets can now help forecast when the market is likely to offer the highest valuation for a company. Timing is everything in private equity. AI is helping get the timing right. All of this sounds exciting. But let's pump the brakes for a second. Where there's potential, there's also risk. AI models are only as good as the data they're trained on. In private equity, data is often messy, unstructured, and private. Training an AI to truly understand private company performance takes enormous effort, and sometimes there just isn't enough quality data to go around. There's also the risk of over-reliance. AI can surface patterns, but it doesn't understand context the way humans do. A company might look great on paper, strong metrics, growing user base, but a seasoned investor might know there's a cultural issue at the top, or industry-wide regulatory risks that AI just doesn't factor in. Then there's the question of transparency. Many AI systems, especially deep learning models, are black boxes. They provide an output, but not always a rationale. That makes decision-making harder to justify, especially when billions of dollars are at stake. Regulators, investors, and stakeholders want to know not just what decision was made, but why. And let's not ignore the human factor. Private equity isn't just about numbers. It's about people relationships, negotiations, trust. AI can't replace a good conversation with a founder or the ability to read a room during a board meeting. That emotional intelligence still matters, and will for a long time. So where does that leave us? We're at a tipping point. The firms that embrace AI early are already pulling ahead. They're sourcing better deals, faster, they're conducting deeper diligence. They're operating their portfolio companies more efficiently, and they're exiting smarter. In a space where margins are thin and competition is fierce, that edge matters. But here's the thing, the AI advantage won't last forever. As adoption spreads, it becomes table stakes. Just like Excel models were once a competitive advantage, but are now expected. The firms that win long-term won't just use AI, they'll integrate it at the core of their strategy.